Okay, excellent. We're the Crypto Invest Funds panel, and I guess what I'd like to do is just go fairly quickly. I give everyone maybe 12 seconds to introduce themselves, say their name and who they are. Let's go round robin. That'll be the last round robin. So my name is Miko Matsumura. I represent Gumi Cryptos, a Japan-domiciled USD-denominated crypto fund, and we are deploying capital.
I'm Yossi Hassan. I represent Techstars. We are the largest accelerator in the world, and I head up their blockchain investments, and I'm also the founding partner in Unchained Capital.
Hi, I'm Antonio Brass. I represent Blockwake, a US-owned centralized exchange.
My name is Jeremy Gardner, serial blockchain entrepreneur, and most recently founder of a hybrid venture hedge fund called Awesome Ventures.
Moshe Joshua, Chief Product Officer of Blackmoon. We are a token issuance platform.
Hey everyone, my name is Andy Bromberg. I'm the co-founder and president of CoinList. We're the platform where the best digital asset companies manage their token sales and airdrops.
Okay, so the first observation I'd like to make is, where the hell is everyone? And I can tell you this much, right, which is I think this is crypto winter, right? So the thing that's real interesting about this is this, which is, you know, I guess the cheap applause line is that the best people are here.
Yeah.
Because all of the, like, we can pump and dump kids are all gone, right? Thank you, Jesus. So what I want to start with is so Jeremy is probably the OG-est crypto in this panel. So I just want to start with Jeremy, and I want to get perspective on, is it crypto winter? Is it nuclear winter? Is it ice age? Like, what the hell is this?
It's getting a little brisk. It doesn't. I mean, it really doesn't feel like crypto winter. I mean, maybe you're seeing something different than I am, but I still see a lot of garbage, like a lot of the crap that we were seeing a year ago. It's definitely not as bad, but you know, I don't think there's been the true shakeout. Unfortunately, too many teams are well capitalized, raised a bunch of money early on, and so they're still around.
So you want more shit to die.
Oh, I want like a nuclear holocaust. I mean, I think there's just, 95% of the startups in this space are not going to be here in 5 to 10 years, and rightfully so. And it's not going to be due to lack of funding. It's going to be due to the fact that they're garbage. So I think we need a much stronger shakeout. I don't know if this is going to be a full-blown winter like we saw from 2014 to 2016. I was with Vinny Lingham a couple nights ago. He said, we're just in the fall. He said, you know, crypto winter is still yet to come. I'm not sure. With all the institutional money coming in, with the college endowments, with Fidelity backed, all these platforms that allow real capital and custodian solutions coming out, I don't know if there's going to be the sort of winter we saw a couple years ago, but there may be, and I wouldn't mind if there was.
That's good. I like that. So I guess to me, the next big question is, why are we here? So I want to toss it over to Andy and get a feeling from him.
Yeah, so I think just building on what Jeremy said there, I think it's worth separating when we talk about is a crypto winter into two different discussions. One is the quality of the companies and the projects and what's actually happening in the space and being built. And the second is the economic markets. And that means both the liquid markets for big cap cryptos like Bitcoin or Ethereum, but also things like the ICO market and the token sale market. Those two things often move in tandem, but not always. And what I'm seeing right now, and I think the reason why we're all here, is that great things are being built right now. And the reason why everyone's in this room is because you see the potential for the value to be created here in the next 6 months, 12 months, but even 2 years, 3 years, 5 years, 10 years. And we're sitting here because we want to see this decentralized future and these projects continue being built. At the same time, I totally agree with Jeremy. We are also still seeing a lot of crap being built at the exact same time, and that has not gone away. So from that perspective, why we're all here is to try and sift through that, to try and find out what's good, what's bad, what's going to drive this industry forward and be successful. In terms of the economic markets, absolutely we've seen a downturn, but the reason why everyone's still here is because that doesn't affect us. We're here to focus on the builders, deciding what's good, what's bad, and how we can move forward and create value, and not focused on the day-to-day price movements and what's happening.
Yeah, so what I'd love to get from Yossi is, what is it that you're seeing that you like? Are there things you're seeing that you like? I mean, we all are seeing lots of things we hate. So let's focus on, what do you like?
Yeah, so there's definitely lots of things that we're seeing that we like. We've been doing a roadshow for Techstars recruiting companies around the world, and we're seeing a couple of buckets of activity in terms of what companies are building. We're seeing a lot of activity in terms of trading tools, better on-ramps and off-ramps for investors to get involved in the industry, better solutions for institutions to be able to get involved. So that's kind of one bucket that we're seeing. We're seeing a lot more activity in terms of how to bring users onto platforms. So I'm seeing a lot of non-fungible token games in different ways to incentivize user behavior.
Yeah, I don't like those. Keep going.
And lastly, we're seeing just infrastructure built out platforms. So we're seeing things like security, analytics tools, and development tools that people need to be able to more rapidly deploy on different blockchains without having to build up the whole infrastructure themselves. And those are kind of the pockets of what we're seeing.
Yeah, that's good. So the tone that I've been getting out of this panel so far, though, is, that part of the blame for this whole thing is like shitty ICOs, right? And I think there's validity to it, and I'll tell you the validity. It's pretty simple. Actually, Vinny Lingham broke it down for me pretty clearly, which is that, if you raise 20 billion in ETH into ICOs, then all of those people are basically burning the ETH, right? So you basically have a $20 billion drag on like ETH, right? So I think, yes, shitty ICOs are a problem, and to paraphrase Jeremy, they need to die.
But it's not really the ICOs. It's the fact that we're dealing with a very nascent technology. This whole conception of what blockchain or a crypto asset is very new. No one actually has a definition for what the hell a blockchain is. I feel like everyone has a different one. Like there's nothing that we've really kind of concluded. This is a blockchain. This isn't. And I've got into all sorts of arguments about this.
So if you're talking about the earliness of a thing, one of the things that actually Andy and I were talking about backstage is kind of not the complement to bad ICOs, which is bad investors. So have we been seeing like bad investors? Where are they right now?
Well, do you mind if I key in on that for a second?
Yeah, jump in if you have a good thing to say.
Yeah, because I think what's missing here is it's so easy to talk about crypto winter because of the price of crypto in terms of US dollars and shitty ICOs and all that stuff. But really, I believe it's crypto spring, and it has been. When we talk about how early it is, I don't think people realize just how early we really are. And the ICO market converting itself and maturing into the STO market with compliance and regulation. Everybody's still waiting around. You mentioned it about the onboarding of institutions now coming into play. I don't think the reason why we're all here had anything to do with currency. As you mentioned, it's all focused on the decentralization of the future. And really, it's the blockchain technology that everybody's focused on.
Yeah,
so
yes and no. I mean, yeah, I have a lot to say, but Yossi's jumping.
I don't think the majority of when Bitcoin price shot up to $20,000, people weren't buying into the decentralized future. They were buying into something that was running, and they had FOMO, and they wanted to get involved in that asset. I think what we've seen is that there's been this massive shift from VCs and institutional investors who had the power in how to go about funding startups.
Yeah.
We were investing in the companies, and we were in the pound seat about who we're going to invest in, how we're going to invest.
Yes.
And if you went in the valley, you were going to get a discount on the valuation of your business. And if you weren't in those circles, you weren't going to get investment.
Centralized capital.
Now we're seeing that as a founder, you had this new mechanism where you could offer a token to invest in your company, and anyone could participate in that. So we really did have shit investors.
Yes, that's
who would
true.
go behind any kind of project. And as a founder, why wouldn't I do that? I didn't have to give away
Totally
control.
agree.
I didn't have to do anything.
Totally agree.
There's no counterbalance to that.
Yes.
And what we're starting to see now is investors getting smarter rather than the founders. And the same amount of shit projects are going to come across the desks. Instead, we're getting smarter and saying, hold on, we're not just going to throw capital at those types of deals. And the retail investors have been hurt. They're also taking a step back. And we're going to see this kind of correction that's happening based on that. But I don't think that the majority of people got into, or at least on the retail side, got into buying into a decentralized future. That kind of idea might be for the technical purists, most of the people who got involved in crypto got involved because they want to make money. And
Yeah, and I think in a way, like the comment about that is more the people sitting in these chairs, right? Which
Yeah.
is, the empty chairs are all the people that were just in it to like make a quick buck, I think. But I think, Andy, you were talking actually about backstage about like actually weaker institutional investors.
Yeah. Well, I
thought
think
that was interesting.
Yeah, and specifically crypto-specific institutional investors. I think a lot of people. I admire anyone that had the conviction to invest real money into the Ethereum crowd sale back in the day, and that is awesome. But going and doing that and having a great crypto track record as a result is not a justification for being an incredible investor that deserves to be managing tens of millions of dollars of other people's money. And so there were a lot of funds that were raised last year, crypto funds that were raised purely on that basis. This track record of I've been investing in the space for 4 years or 3 years. I invested in the Ethereum crowd sale, and look at this, I'm up so many thousands of percentage points. But that's one investment, and maybe 2 investments, but that's not a real track record. And so there's a lot of people that are not strong investors that now have these crypto funds sitting there and are managing this money. And a lot of them, because they are unprofessional and don't understand how these markets really work and how to manage a fund, are making all sorts of mistakes along the way. So, Jeremy, for example, mentioned this in his intro. He's got this hybrid venture fund, hedge fund structure. But a lot of people were just conflating those two ideas and saying, I'm investing in something for the long term, but these things I'm just going to trade in and out of, and on a whim, this thing that I made a long-term bet on, I might get out of because I think it's going to go down. And it's really important to maintain, like Jeremy said, that separation of those two things and saying, we know what we're investing in and making these long-term bets on, we know what we're going to trade in and out of. But there's this massive set of investors that have no professional experience running funds, managing tens of millions of dollars of capital.
So
no
I think
Well,
I think
and
yeah,
you
go
can't
ahead.
really have a hedge fund in crypto because there's nothing to hedge with. Everything's correlated. I mean, unless you're doing really smart algo trading, it's very hard to time this
except
market.
Tether.
What?
Except Tether.
Yeah, I mean, literally, these markets are just about impossible to time. So it's claiming that you're going to go run a hedge fund, it's why 98% of all hedge funds in this industry are down this year.
Yeah, and I call BS on a lot of the kind of algo trader things, especially like machine learning, right? Because what are the machines learning?
Well, sentiment analysis, if you look at Twitter is a great indicator of crypto prices. Like when you combine that with all these other social networks and you look at trading trends and you like look at something like wave analysis, which is total horseshit, utter garbage, all TA is. But people trade based off of that.
They do.
So you can actually game people based off their shitty technical analysis
Agreed.
using the theory that's in these books, even though you don't believe it in yourself because you know that's how this person's going to make their next trade.
But at the same time, there's so little market data historically for most of these.
No, I mean, look, you shouldn't trade crypto. Like, you should literally invest for the long term, and more importantly, if you're going to have a fund, you should be acting like a venture capitalist.
But here's the great thing, right? Is that let's look at where the money. Let's follow the money for a second, right? So here's what we've learned. We've learned that like there's a bunch of shitty ICOs, right? Most of them are like bleeding money, like nobody's business, right? We've learned that there's a bunch of like not that great investors, right? So they're bleeding money and all the money's going away. But if you look over in the corner, what you notice that there's actually these exchanges that are like amassing gigantic piles of money, and it must be coming from someone or somewhere.
I actually have an answer for this, and it goes, Jeremy's 100% correct.
All right, fire away.
You have to define the difference between an investor and a trader and a speculator.
Yes, totally agree.
Okay? So tokens and security tokens and ICOs have a great way, well, maybe not ICOs, but they have a great way to make it more efficient for proof of ownership. That's the value proposition that they have when compared to traditional paper that you receive as equity.
Stay on point here.
Exchanges are not built for investors. They're an industry and an ecosystem built for traders. And Jeremy's right. The exchanges have not provided the toolbox and the tool
I think
belt
it's worse than
for
that.
traders
I think it's
for
way
arbitrage.
worse than that. I think you're totally missing the point. The point is that in order to become the largest exchange in the world, you take custody of user funds and you use it for market manipulation, right? And if you don't, then you're not the largest exchange
Well, no,
in the
that's
world.
just fake liquidity, okay?
No, you're totally off. Like, to me, fake liquidity is a separate issue. They're also doing that.
Yeah.
They're also like wash trading with bots, right? And there's certain exchanges like Fcoin that are incentivizing users to wash trade with bots. That's a separate issue, right? Like,
What's the point? That
take
they're,
take
that
something
they're
like
custodianing
take something
too
like
many
Tron.
funds and just acting as a vacuum?
Take
Is that-
something like Tron, right? So Tron pumps to 17 billion, and they don't even have a test net, right? It's worth more than Litecoin on a given day. And then, of course, what happens next? It dumps down to 2 billion. $2 billion worth of like bag holders, and it's basically like your local Uber driver, right? So
My Uber driver tried to sell me on Tron, actually.
boom, boom, right? And why is that? Why are they the Tron evangelists? Because they got in at like 17 billion, and now they got nowhere to go, right? So I guess my point is how do you engineer something like that? Well, it's well known how to do that, right? It's
Because
basic-
investors are not traders. That's the point. Investors, the goal of an investor is to invest in a company and sit on it and watch the company.
Yeah, the
grow.
investors are losing.
The investors are always going to lose if the financial products available to traders are not there to provide the liquidity for them. That's the key point, is that the exchanges is where the profit comes from because it's the only place to get it, but there's not enough of an ecosystem in place to generate the liquidity for investors to take profit from.
I don't think the issue with that Tron crash was about a lack of Tron financial products
Agreed.
available to trade.
Totally agree. Totally agree.
Well, I'm
I think you're-
not talking specifically about Tron. Specifically.
Yeah,
Look,
but
I'll
we-
give you
but
another
we-
way
the
to
rest
think
of us
about
are,
it.
though.
I'll give you another way to think about it. The difference between publicly traded stocks and privately traded stocks is just a function of normalized reporting standards. So there's no way in the private marketplace to compare two companies against one another. So when an investor is thinking about their investment and the ongoing relationship between the comparative analysis or the correlation that you're talking about, Jeremy,
Yeah,
related
I
to two
think
companies, there's no way to compare.
I think you've got your lens, but I think you're really trying to steer this off course. Like Jeremy's like, what the hell are you talking
I'm totally lost.
Yeah, that's my point, and I feel the same way,
You know, to
right?
both, to both your
Uber-
points. Sorry.
The point I'm trying to drive at is like, who's losing money, who's gaining money, why are they gaining
All right,
money?
no,
I think-
no one's really making money right now, except the exchanges.
Boom.
That
Boom.
is the point here.
That's the point.
And if you're on an exchange, you're probably a sucker. I literally have not been on an exchange in 6 months.
So we're trying to solve that.
Well, I mean, I just gave you the answer. Just don't log on. Like literally, unless you're trying to buy a crypto to add to your portfolio for the long term and then gonna sit on it for 2 to 3 years, don't log on to an exchange. There's literally, that's the only thing I have to say to this
So
audience.
what's the purpose of having a token? Just take equity and just do a traditional market. We don't need tokens. We don't need a decentralized market. The world works.
I actually publish a 108-page magazine called Distributed. I'll give it to you. It's great. It will give you all the great use cases for tokenization that are not speculation. There are a lot of use cases for crypto assets for creating built-in incentive systems and different types of economic networks for things like remittances.
This is the utility token idea?
Yeah, sometimes.
Okay.
So sometimes you get protocol tokens, decentralized file storage, decentralized governance solutions.
Not a single one of them has anything to do with investments.
Well, yes, you can invest in these underlying tokens, but you're investing in the same way.
By the way, I'm agreeing with you. I'm just trying to understand that if there are no exchanges and there's no way.
No, I think there should be exchanges. I think people should use them to buy cryptos. And if they find that there's a project they like more and they don't have money, you sell one crypto and buy the other. But stop trying to be a trader. You can't be a trader in this space. It's just like
We agree.
you're eventually going to lose money. And so the point here is that when you're thinking about cryptos and trying to learn about cryptos, go and actually take the time to learn about the projects, not learn about whether they're going to go up in the next 6 months. Because guess what? No one's using crypto products today. Find the teams that are actually building something real that may be deployed and adopted over the next, 2, 3, 4 years, and that's how you make a winning investment.
But there's always going to be traders like every other market, right? There's that segment, they want to trade.
Sure, but we're on an investment panel, and I'm trying to give good advice.
Hold on, very good. Very good. That's a good applause line. Yeah, I mean, the thing that's really interesting that I wanted to point out, though, is that if you look at who's there, right now there's builders, right? There are investors who want to support builders, right? Then there are like traders, or you could also call them suckers. And then there's exchanges.
And there's the shillers.
Well,
You have the shillers.
but all the people I've named prior to exchanges are all getting like abused. Like they're all losing money, right?
Well,
And the
but
exchanges
I
are
mean,
making
you can do a POC for a Fortune 500 company and make money. Just they're never going to deploy it because they'll realize it's an existential threat to their business. But there's plenty of money to be made in crypto today. There are lots of people that want. I mean, you get offered probably advisory gigs, consulting gigs all the time. There are plenty of ways to make money in this space. But yeah, we're not making products that people want to use yet. So yeah, there's no money to be made.
Yes, that is a pretty big thing. So you're kind of coming from an exchange perspective,
Yeah.
Antonio. So what's your perspective on this discussion so far?
I'm here to listen. I want to know what these guys need and want, so we bring that on board with our platform. My background's financial services, a lot of regulatory compliance stuff. So Moshe was bringing up reporting. That's one of the things we want to do. Like, you have all these exchanges. There's no transparency. They don't do any reg reporting to anyone. We don't know what's going on. You brought up
Transparency.
manipulation, right?
Yes,
So, these are things we want to be able to address through some type of transparent reporting to customers, to regulators, to try to address some of the shady practices that are going on there.
Yeah, I think that's pretty important. Yossi?
Well, can I make a point about investors not making money in this asset class? I think if you look at traditional venture investing, the outlook on a return is 7 to 10 years.
Yep.
The only thing that's different in this new way of investing in either decentralized companies or centralized companies trying to build some kind of decentralized solution is that there's a liquidity event that happens earlier, and you have the option of potentially trading on that asset at a sooner time point. Instead of having to wait 7 to 10 years, you now have the option of potentially 6 months to a year. Now, that's not a small thing and not a small difference, but venture investing and building new technology still takes 5 to 10 years. It's still a long haul of finding product market fit, getting a user base, tinkering with the technology, trying to make it usable. All of that stuff didn't just go away all of a sudden because we have a new way to tokenize, network, and incentivize behaviors and potentially bring liquidity into what used to be an illiquid asset class. So you will start seeing that some of these businesses are going to start being successful and growing, pivoting, doing everything that a typical venture business would have done, and liquidity coming to those businesses, but it's still going to take time. And I think what we had is this moon to Bitcoin and everyone expecting to get rich just by investing today, flip it in 3 months' time, and that cycle has to continue all the time.
Yeah.
Exchanges were part of that. A lot of investors who were giving advice and shilling their next token were part of that because they were getting incentivized to do it. And that's why we have the Uber driver who's left with Tron today.
Bag holders. Yeah.
Tokens only have really two basic advantages compared to the traditional market. It's proof of ownership and liquidity potential.
That's maybe debatable.
What? I mean,
That's
there's a
debatable.
lot of color in between those two things, but ultimately, if you boil it down to it, those are the two advantages that people get from tokenization.
I think that you're coming at it from a purely like security token mindset. Like,
Yeah, I mean, like global accessibility is a massive thing. You have a universal payment system or a tool for engagement with customers. I mean, that's massive.
I agree. It's an issuance of credit just like a stock is. It's an issuance of credit just like a reward point is, or miles points, or it's
think
just,
you're-
it's just
I
a
think-
proof of ownership argument in the same respect of I own miles from my airline or I own a utility token from a company.
The issue I'm having is that the lens that you're bringing, it conflates multiple issues, and so it produces very janky conversation. Because in a way, like you're taking a security token type of a perspective, and you're breaking it all down for us, but you're really like disregarding the
Well,
existence of
yeah. I mean, you're missing let's talk about Ether. I mean, Ether is used to incentivize the validation of all transactions in the network. That does not meet either of your two use cases
That's the
for a
point.
crypto token.
I don't believe in the existence. I don't think cryptocurrencies have any real value from a US dollar perspective. And I agree with you that there is a use case for a utility token. But I want you to guys
Well, I mean, we
recognize-
can very flatly just reject that statement by looking at how Bitcoin operates. Bitcoin has a cost associated with producing it, and then people who assign a value to it decide to purchase it.
That's fine. They can assign a value to it. I just can disagree with them. That's okay. It's ultimately what I'm trying to say is that all those token use cases that are in your 180-page book, don't differentiate from rewards points systems that exist today, other than the fact that they provide a better proof of ownership stake. It has nothing to do with security tokens.
Well,
I'm
they
sorry
don't,
to be
they
talking.
don't have central issuers. I mean, these are decentralized, often
Proof
organizations.
of ownership, right? We can prove in a trusted network who owns it.
Let's nip this conversation in.
Yeah, this isn't going anywhere.
Yeah,
Sorry.
it's a rat hole, and and I think it's not giving anyone any insight. So,
Can we take a step back though and talk about, I think, and this goes back to one of the first questions you asked.
Andy, thank you.
Yeah, why we're all
Thank you.
here. And I think it really goes back to thinking about the fundamental use case of tokens and blockchain technology and why we're all building this. And for me, it really comes down to, can you build a better incentive system? The whole point of a token is we're going to take something that might have been done in the traditional world, may not have been done yet in the traditional world, and try and build a system where every single party who uses that system is properly incentivized to do the right thing, and all the potential antagonists in that system are properly disincentivized from doing the wrong thing. And you can look at that for something like Bitcoin as a store of value, for Ether as a transaction validator, for something like Filecoin, a decentralized file storage network, a security token certainly. And what you're trying to build is an incentive system that properly rewards people, and that incentive system can result in value accrual for that token. And that's where that kind of cryptocurrency or crypto asset value comes from, is from a properly designed incentive system. But going back to the question of all this bad stuff that's happening, most of these tokens that we see have poorly designed incentive systems, and ones where I absolutely agree, most of them do not have any value in the long term because the incentive systems are broken and won't result in value accrual to that token. But when you look at the systems, the benefit of all of this technology is for the first time enabling peer-to-peer incentive systems with no centralized party managing it. Is that like rewards points? I don't really think so, because rewards points are all single-player actions with one centralized counterparty. I get my American Airlines Advantage miles, I spend them, it's great, I love that product, but it is not a matter of me interacting with other peers in the network, and it is certainly not a matter of me interacting with a decentralized network, which is where the power of this technology emerges.
So I think what's important, what Andy's just mentioned there, is this idea of value accrual in the token and the structure of that token. I think what we've seen is a number of projects, and I'm going to take the bad actors out, the projects that genuinely were trying to build something of value. I think that trying to create this value accrual in the token is a very difficult thing to do. So what we've seen is some networks which are extremely valuable, and we can argue that Ethereum is an extremely valuable network. It's done something remarkable in terms about building a worldwide compute infrastructure that allows
I think it's a vending machine for securities.
well, we could talk about that, but you have the ability to create smart contracts, but has that been able to capture the value on the network? It's struggling to do that. And this is a nascent field. We've got this term token economics, as if it's been around, and there's PhDs who've studied it. This is still being figured out as we go along.
The thing that annoys me though is like PhD advisors for tokenomics that will charge you a lot of tokens or money, right? Because it's actually not that hard, right? It's not the thing that's not that hard is
Well, it's really hard because what has been successful?
But so I think Andy's point was super valuable, right? Which is that if you think about incentive systems, at the base of all of the so-called utility token thesis is utility, right? So to me, one of the broken things about the incentives is we're buying Chuck E. Cheese tokens before there's a Chuck E. Cheese, right? So so that's broken, right? But to me, what I mean by tokenomics may not actually be that hard, is pick a day. Did more people in volume buy or did they sell, right? And then the question becomes, why did they buy, right? And you can split the why did they buy into speculative reasons. Obviously, that includes possibly investment reasons, but at the base of it is buying either for ownership of an asset, which is an asset back, or access to a service, which would be a service back. Right?
I think this ties back, though, to something we mentioned earlier. I forget who said it, but that the terminology is super unclear in this industry, and
Yes.
people overload these terms in all sorts of different ways. So when I think about what you're talking about, Miko, absolutely huge question of why are people buying and where is the value coming from in the market. But I think of that as token market economics. So what is actually driving the market value traded on exchanges of a token? And I see that as a separate thing from, again, this is the words that we happen to use at CoinList, the token economics, which to me is the internal economic system of the token. So the token network has a bunch of users on it. If we take Filecoin as an example, there's people that have files to store, there's people with storage space in excess, there's people that validate transactions. And the token economic system, the token economic design is are all of those parties appropriately incentivized and disincentivized within the system to do it? And that is mostly irrespective of the actual market price of that token, although it plays a role.
But there kind of aren't, right? In the case of Filecoin, like I own Filecoin, and I haven't been able to use it to store anything.
But that's the point. That's the point that Jeremy's trying to make, is that if you have a utility token, it's what you're talking about. Don't list it on an exchange. The fact that you have a convertible ratio to US dollar value shouldn't exist. The whole idea of utility is that it shouldn't have a relative value to anything else because it's giving you the utility on the network that it's being issued for. On that level, I agree. But the moment you list that token on an exchange and you allow it to be traded at some floating rate, you include, and have to include, and it's irresponsible to not include all the other things that I'm talking about, and I'm sorry if my lens is too narrow-minded here, but the moment you list it on an exchange, liquidity becomes the #1 focus of everybody. It becomes the item in which everybody can see the value proposition, or which removes the utility.
But like, look at the way that CoinList is doing things, because I mean, there is a model for this that now exists. You go and sell only to accredited investors early on. You bootstrap the platform to the point where the network's available to be launched, and then at the time of the launch, you release the tokens. Very simple solution to this problem. I mean, this is how token sales should be operating. This is how anybody that actually needs a token should operate. They should only be taking money from accredited investors, people that are qualified.
Why should I only be taking money from accredited?
Or doing it on a platform like Republic, where there's a platform where unaccredited investors can participate, but not put like too much in. You know, like I think there needs to be some.
So I think what we're seeing
balances.
is a shift in investors, or at least there's a concept called. And you're probably very familiar with the CoinList because the CoinFund guys talk about generalized mining as a shift in how investors start participating on networks. So we went from being an equity investor because blockchain was the thing that everyone needed to invest in. Then it became about the token and everyone became a token holder, and now we're just bag holders. So we're no longer token holders. We're now going back into equity. And what we're seeing is that later venture capital funds and investors are actually starting to say, we need to be participants on the network. So we need to actually be where we've gone from just being a miner and a user. We now have delegators, we've got validators, we've got syndicators, we've got all these different roles to play on the network. And actually being an investor in the network is now being part of the network, being an infrastructure provider, being one of those nodes, being a validator on the network and actually contributing to the project. And helping actually build out this network, because it does take time because of all the things that need to happen with it. Actually, that's the role of being a true investor in this ecosystem.
Well, the thing that leaps to my mind, actually, which is kind of the shadow version of what you're talking about, is, you know, most recently, Huobi, one of those crazy centralized exchanges, was basically seen using the user funds to vote for EOS block producers, right? So like, that's just crazy. And the thing that's amazing about that is that's something that's exceedingly visible, right? So as soon as they start doing it, everyone's like, wow, that's a crazy abuse, right? But the thing that's really funny about all of that is that it's actually unknown what's happening behind closed doors, right? Like the stuff that's happening off-chain, we actually have no idea what they're doing. So
I mean, this is the biggest existential threat to this industry.
Yeah.
It's not that blockchain technology is going to fail, Bitcoin's going to fail. I really just don't think that's going to happen. I mean, some cryptos may fail, but blockchains, distributed ledger tech, it's here to stay.
Yeah.
The real concern is that we just become Wall Street 2.0. That's what's mortifying to me. I mean, when I came into this industry, I was pretty much like the only liberal or progressive in the entire space. I came from Occupy Wall Street. I wasn't a libertarian or an anarchist.
But yet accredited investors are the ones that need to be able to invest in pre-seed.
Yeah, I mean, look, an early stage startup that's pretty much just an idea is 98% likely going to fail, and selling that product to people that are unscrupulous investors is unethical. I literally do.
So only wealthy people are the people who can have access to new technology.
No, I think there should be access to venture funds. It should be easier. This is what we did with Blockchain Capital by tokenizing BCAP, like making venture funds accessible for people to invest in. And I think platforms like Republic, which vet projects beforehand and allow unaccredited investors to participate in these sales, great ideas. But at the end of the day, you know, the fact is that no matter how great an ICO sounds, it's probably going to fail. And I think we've really got to be mindful of that. I mean, people have lost a lot of money. It's been pretty clear that we can't self-regulate. We can't. People are too greedy. And that goes back to my driving point here. Not becoming Wall Street 2.0. Because that's what Wall Street does. They just pile shitty, kind of toxic financial instruments on unsuspecting investors. And the world suffers as a result.
I don't even think that's a choice, what you're saying. It's not a choice. It's not a choice because ultimately, what's the security? When you take an investment from an investor,
I got to retort to Jeremy. So yeah, I'm going to take moderator's privilege with it. So to me, like when you talk about like Wall Street 2.0, right? The thing that I think is important to think about is like when will the centralized exchanges be too big to fail, right? And I think one of the things that we saw
they were with Gox. I mean, Gox.
That's the point.
Triggered the first crypto winter.
That's the point. And when you actually look at what happened with FSA in Japan and the Japanese regulators around the hack of CoinCheck, it's apocalyptic there.
they're not exchanges. They're just websites. They're just companies that.
Yeah, but you're
love to miss the point.
I'm not missing the point here. The point that I'm trying to make is that when we're talking about investors investing in these coins and you're taking money. Well, hold on. Okay. When you're taking money from investors, whether you like it or not, they're securities. They're securities because the regulators say they're securities.
The reason why I don't want you to continue is that you keep grinding your lens and it doesn't contribute. So. Let's keep this on.
And some of them are not security. I mean, the regulators have come out and at least in
ETH
informal
is not a
statements
security.
said Ethereum and Bitcoin are not securities.
Correct. But as a general rule, industry-wide,
you can't have general rules when you have a paradigm-shifting technology that spans every fucking industry. It's just that there are no general rules, man. I mean,
and when more than half the value. And especially when more than half the value by market cap of this industry is in the non-securities tokens that exist.
I think they're all securities.
You think Bitcoin and Ethereum are securities?
No, not Bitcoin.
Well, that's
so
where more than half
you
the
can't
value
have
is.
it both ways.
All right, so let's zoom back. So we do have an entire panel upcoming called Are Security Tokens the Future? So we will have the opportunity as an organization, not us, to talk about this at great length. But to me, what I'd love to do is kind of bat the ball back to Andy. With respect to what you were describing, because one of the things I did want to honor is that when you describe incentivization, I really feel like that's in some ways a crux, right? And it's a crux in the sense that like people who are blockchain but not Bitcoiners are really focusing on the wrong layer, because the layer that produces the most effect is the incentivization. So I just wanted to kind of bat it back to you and talk about kind of investment from the perspective of incentivization.
Yeah, it goes right back, and it's a great question. It goes right back to what Yossi was saying after we talked about that, which is the value accrual is the most important part of this. Blockchain technology is incredible. Like Jeremy said, it's here to stay. But it is a means to an end of designing effective incentive systems that will result in decentralized distributed networks of human beings and machines collaborating to produce results that make sense for the world and result in more economically efficient markets. That is a beautiful thing, and it only works when those markets actually accrue value as a result of those tokens accruing value in those networks. So when we talk about incentive design, it is about when all these parties act together in the right way, does the token that they are using as a means of exchange or store value or whatever it may be, unit of account on that system, grow in value? If it does, that is a successfully designed token.
Well,
what we should all be focused on
Andy.
is how do we design these incentive systems positively?
I think that's great, but we've just missed the point this entire panel. We're talking about like the what and the how. But we're not talking about the why. Like, why do you want to use blockchain technology? We haven't answered that once on this panel. And I think if we're talking about investment, we have to talk about why do you use a blockchain? And there are really two core driving reasons: censorship resistance and the disintermediation of middlemen. If you're not doing one of those two things, you probably don't need a blockchain. And that's why 95% of the companies in this space are crap, because they're not actually solving a problem that's solved by a blockchain. Blockchain is just a pretty buzzword. If you don't have an application that's at risk of being shut down by your local government, by like being hacked by banks or like large supranational entities that want to take you down or hackers, you probably don't need a blockchain. But there's some cases where you just want to disintermediate middlemen. You want to get rid of like centralized land title registries, and that's great. But if you're not answering those two things, you probably just don't need a blockchain to begin with. And that's what we really need to focus on. Before we design incentive systems, do we actually need a decentralized system to begin with? Because guess what? Centralized systems are a hell of a lot easier to build, maintain, and make operate for your average consumer.
And so to answer that question directly that you asked, I totally agree with Jeremy. Step one, does this system even need a blockchain? If no, do not move on. But if yes, then you sit back and say, is the incentive system designed well enough to support the value of the token in the long term? If yes, maybe worthwhile as an investment, still obviously very risky to the points made earlier. But if those incentive systems aren't there, you should not be investing in that token.
Okay,
Agreed.
well, we ran out the clock. What I do want to say, just in closing, is that we're all here for good reasons, which is we want to deliver and ship software that adds value. And so, I think that's what the investment community needs and wants, and that's what this industry needs. So, let's get to work. All right, thanks everyone.
Thank you.